Vanguard finally did something many of us, including me, had been waiting for 6 years already. They cut the fees of some of their largest ETFs in Europe, including the Vanguard FTSE All World. Since my wife and I hold several €100,000 in this ETF, both in its distributing and accumulating version, I'm obviously very happy to see that. After all, a lower yearly total expense ratio can compound substantial savings over decades. But after digging into the details of what has been happening behind the scenes at Vanguard in Europe, I discovered something that changed my perspective on this. So let's take a closer look at exactly what Vanguard did, how the Vanguard FTSE All World now compares to other global ETFs in Europe, and most importantly, does this mean my wife and I are switching our monthly investments back to Vanguard? If you're new here, my name is Angelo, and I've been investing in low-cost ETFs for over 8 years together with my wife, with the goal of being able to retire early in a few years if things go well. Alright, so let's start with what actually happened. On October 7th, 2025, Vanguard lowered the total expense ratio on their FTSE All World ETF from 0.22% to 0.19% per year. That's a 0.03 percentage point reduction, which is around a 14% decrease in fees. They also cut fees on 5 other European ETFs, like emerging markets, which dropped from 0.22 to 0.17%, Japan from 0.15 to 0.1%, or North America from 0.1 to 0.08%. Now, for my wife and me personally, this is genuinely good news. With around €365,000 in Vanguard ETF shares, this 0.03% reduction saves us around €110 per year, which could compound to around €33,000 extra over 30 years, assuming 8% annual returns. So yes, even a tiny 0.03% matters when you have a substantial amount invested. I'm definitely not complaining about the reduction in fees, but here's where things get interesting. Let's see how Vanguard now compares to other global ETFs that cover both developed and emerging markets. While it now barely managed to finally undercut the iShares MSCI All Country World, the even broader SPDR MSCI All Country World Investable Market ETF only charges 0.17%. The Invesco ETF covering the same FTSE All World index is still 0.04 percentage points cheaper at 0.15%. The SPYY MSCI All Country World is even less expensive at 0.12%, and at only 0.07% per year, the Amundi Prime All Country World is still by far the most cost-effective global ETF. So sadly, even after this fee cut, Vanguard remains one of the most expensive options for a global ETF in Europe. And as I've shown you before, even small differences in yearly fees can compound substantial amounts over several decades. Speaking of long-term investing, you can find my link to Interactive Brokers, my favorite low-cost broker for ETFs in Europe, down below in the description, which is a great way to support me if you'd like to. Now let's talk about the timing, because this is where things start to get frustrating. We've been waiting for as long as 6 years, since October 2019, for Vanguard to finally lower their total expense ratios. 6 years of complete silence while their competitors were aggressively cutting fees and new, less expensive ETFs entered the scene. While Vanguard's US-based ETFs continued pushing their costs lower on an almost yearly basis, it felt like they just stopped caring about their European investors, completely ignoring their stated mission statement of putting investors first, even as their ETFs became larger and larger in fund size. Instead of using this opportunity to push fees as low as possible and improve its image in Europe, Vanguard did the bare minimum. A reduction of only 0.03% means we're still paying more than 3 times as much in fees compared to the US-based global ETF equivalent, the Vanguard Total World Stock, at only 0.06% per year, which is even broader, containing almost 3 times as many stocks. Not to mention many other Vanguard ETFs like their highly popular S&P 500, which remain unchanged with 2 to 3 times higher costs compared to the US. So, what finally made them move after 6 years of ignoring us? Well, Vanguard has started losing market share. While they were reportedly capturing around 80% of all new money flowing into global equity ETFs in 2020, it dropped to 53% in 2025, as more Europeans are picking other ETFs instead. The sad thing is that Vanguard continues profiting from its strong reputation in the US, where it has always kept fees to a minimum. I wouldn't be surprised if many Europeans actually ended up picking Vanguard because their US-based ETFs are so often mentioned positively by American finance bloggers and YouTubers. So to me, this tiny fee cut feels more like damage control in light of all the criticism Vanguard has been receiving from the European investor community for its comparatively high fees, and not a change in strategy to finally align with its stated mission, value to investors. Because now they can say that they did in fact cut their fees, even if the reality is that they didn't even try to match the competition. Okay, but where is all of Vanguard's European revenue going then? Here's where things get interesting. Banker on Wheels did some fantastic research digging through Vanguard's European financial statements. I'll link the full article down below so you can check it out yourself afterwards. And what they found is pretty shocking. In fact, it confirmed what I had been suspecting for a while now. Between 2020 and 2023, Vanguard Ireland's revenue jumped by 46%, from $197 million to $287 million. That's significant growth, which should normally translate to higher efficiency. With savings, you could then pass on to your customers via lower fees, right? Well, here's what Vanguard did instead. Vanguard Europe is paying its parent company Vanguard US so-called service fees, which it continued increasing as its revenue grew, from 67% of revenue in 2020 to as much as 80% of revenue in 2023 based on public filings. To put it simply, out of every 5 euros in fees you pay to Vanguard, 4 euros are transferred back to the United States. This way, Vanguard's European operations maintain a razor-thin profit margin of only 2%, leaving no room for fee reductions. So, what does this actually mean? It's sadly a confirmation of what many of us expected the past few years. In Europe, Vanguard simply isn't designed to become more efficient and pass savings on to European investors as it grows. Instead, it seems to be structured to extract as much profit as possible from European investors and to funnel that money back to the United States, where it is then used to subsidize ultra-low fees for US-based Vanguard ETFs. That is why Americans pay 0.06% for a total world ETF, while we're paying 0.19%, more than 3 times as much. And it's why Vanguard cuts fees in the US almost every year, while we European investors wait 6 years for a 0.03% reduction. We are paying more than necessary in yearly fees, so American investors can pay less. I honestly find all of this so disappointing. When I bought my first Vanguard ETF shares back in 2018, I genuinely believed in their mission and was confident I would never have to look for another fund provider. I mean, we're talking about Vanguard, the company founded by John Bogle to democratize investing and put investors first. In the US, they've always been known for driving fees as low as possible, forcing the competition to do the same. That's why so many of us picked them. Surely they would do the same here as well. And yet, while their European website still says that they believe an investment company should manage its funds solely in the interests of its clients, that doesn't seem to apply to its ETFs in Europe. And now you know why. Okay, but why is Vanguard doing this? It all comes down to the ownership structure. Vanguard's US parent company is owned by its US-based funds, which means it's ultimately owned by its American investors. And since that parent company owns Vanguard Ireland in Europe, its European revenue ultimately serves the interests of its US investors, since that is Vanguard US's primary goal due to its structure. In my opinion, Vanguard made a huge mistake setting up its European operations this way. They should have been independent from the start. I'm confident their fees would have been significantly lower by now if that had been the case. Alright, so after everything we've discussed, here's how we're handling this situation. If you currently own Vanguard shares and they're in profit, hold on to them. This is really important, as I see far too many people make this mistake. Our own Vanguard ETF shares are up between 43 to 76% on average. Selling them to switch to a less expensive alternative makes no sense, since we would then have to fully tax those profits already. The difference in yearly fees is unlikely to make up for this immediate tax hit for several decades at least, which means we're keeping all our existing Vanguard shares and we're only selling them once we actually need the money, for example in retirement. As for our monthly savings, we'll continue investing those into the accumulating Invesco FTSE All World, which we switched to in June 2024, as it's still 0.04% cheaper even after Vanguard's cut, covers the same index, and has beaten Vanguard's ETF returns by 0.07% the past 12 months and 0.29% the year before. It's perfectly fine if you prefer another ETF, for example by SPDR or Amundi. This is simply the one we chose, in part because Invesco ETFs seem to be more tax efficient in Austria throughout the holding period, just like Vanguard. This part is completely irrelevant if you live in any other country though, and if you prefer sticking with Vanguard, that is also perfectly fine. Investing in the first place and sticking to your strategy over the long run matters way more than the 0.04 to 0.12% difference in yearly fees between global ETFs. Picking one over the other is not suddenly going to make or break your investment strategy. So, am I switching back to Vanguard? No. Look, I'm genuinely glad that Vanguard finally cut their fees after 6 years. For us, this change could compound to 33,000 euros in extra wealth over 30 years if we calculate with an average annual return of 8%. That's a meaningful amount and I do appreciate it. But a minimal 0.03 percentage point reduction after 6 years without even trying to match the competition certainly doesn't feel like a realignment with Vanguard's principles and more like damage control. The sad reality is that even after this fee cut, Vanguard remains one of the most expensive global ETF options in Europe, and now we know why. 80% of its revenue seems to be leaving the continent to subsidize its US-based fund fees. While we're keeping our existing Vanguard shares for tax reasons, our monthly savings will continue going to another ETF. And looking back, I'm glad we already switched over a year ago instead of continuing to wait for what turned out to be a disappointingly small fee reduction by Vanguard after such a long time. I would love to see Vanguard make real competitive cuts in Europe, pushing fees as low as possible, and living up to its founding mission for all investors, not just Americans. But I just can't see that happening right now given how they're legally structured, with clear incentives to funnel European revenue to the US. I would love for Vanguard to prove me wrong. Until then, my wife and I will continue voting with our wallets by investing in another ETF on a monthly basis. You can find my link to Interactive Brokers, my favorite low-cost broker in Europe, down below in the description, which is a great way to support me if you'd like to. But now I'd love to hear from you guys. Does this fee cut change your perspective on Vanguard? Let me know in the comments. And before you suddenly start looking for ways to circumvent EU regulations and buy Vanguard's cheaper US-based ETFs, you need to watch this video right here, as you need to know about US estate tax, which can be as high as 40% of the total amount you invest. Thank you for watching, and I'll see you in the next one.